Okay, dear students, this is Mustafa Mirchawala, your trainer, and today we are going to discuss IFRS 18. Okay, now very short. This standard will become mandatory in on 1st January 2027, right? But right now it has been launched in April 2024, and it's on voluntary basis. Any company can adopt it. Okay, now lot of things in this standard are the revisions of the previous studies which you have done. The first thing is that there is one thing which is constant in the society, that is change. Okay, so this change comes in ACCA qualification, this change comes in your strategic level papers, this change even comes in IFRS. So right now IFRS 18 replaces the IAS 1, right? And IAS 1 deals with the presentation of SOCI, SOCI, Statement of Changes in Equity, SOFP. So now, from now onwards, IFRS 18 will be applied on it. Okay. Now, key things, key improvements. Number one, new defined subtotals in the statement of profit and loss. Now, the major changes, definitely I'll discuss this in detail as well. The first change is now income statement. In the income statement there will be sections like operating activities, investing, financing, and so on, just like SOCF, statement of cash flow. You have studied statement of cash flow previously. In a statement of cash flows you have operating activities, investing activities, financing activities. Same is the case with income statement now. Okay, so that's why there will be new terminologies: operating profit, profit before financing, and income taxes. Okay, the second change, very important, management defined performance measures. Now what is this? Listen, there are certain very famous ratios like return on capital employed, gross profit margin, net profit margin, gearing, current ratio, quick ratio. These are famous ratios and these are normally covered in every financial statement. But there are companies, they want to use new different types of ratios according to their needs, and that topic is called alternative performance management, alternative performance measurement. And yes, I have already covered this topic in very detail, and it is included in your LMS, right? Okay, but previously this APM area is not under the control of IFRS. This was non-IFRS area. This was a non-GAAP area, means no accounting standards governed on this. So this APM area was covered by European boards and European bodies, and they used to give different guidance on this APM. But now after IFRS 18, first of all, they have changed the name of this APM as management defined performance measures. So there are certain performance measures which management sees, which through which management checks the performance of the companies. So now these management performance measures will be dealt by IFRS 18. Now IFRS 18 will give guidance that which to include, what are the criteria to include, and this type of things. Okay, so entities must disclose subtotals, and definitely I'll cover this in more detail in this IFRS 18. Entities must disclose subtotals of income and expenses not specified by IFRS if these are publicly communicated and used to reflect management view of performance. Now, third thing is enhance aggregation and disaggregation. Aggregation means which things to present in a group and which things not to be included in the group. This is the thing. Now, retention and reallocation of IS1 contents. Yes, as this is the replacement, now IFRS IS1 is replaced by IFRS 18. So there are some paragraph of IS1, they are copy paste in IFRS 18. Then other sections have been moved to IS 8 and IFRS 7. Some topics are moved to IS 8 and some topics are moved to IFRS 7. You know what is IFRS 7? IFRS 7 is basically the disclosure standard of financial instrument. Hope you remember the financial instrument area. Financial instrument area. In financial instrument area, there is a disclosure standard as well, as that is IFRS 7. Now, recent development, IFRS 18 was issued in April 2024. It has been subject to minor consequential amendments, including those from IFRS 19. Listen, right now in this class, I'm not going to cover IFRS 19, but yes, We'll include this IFRS 19 also in your LMS. We'll include IFRS 19 also in your LMS, right? Okay. Listen, IFRS 19, let me tell you, it's about the subsidiaries individual books. Remember parent subsidiary consolidation, what things to disclose in subsidiaries individual books. It's all about that IFRS 19. Okay, right now we are not doing it. Now, purpose and scope. The standard applies to general purpose financial statement and aims to ensure information is relevant and faithfully represent all assets, liabilities, equity, income, and expenses. It's all about presentation, right? So you should report relevant and faithful representation. Okay. Where and when does IFRS 18 apply? IFRS 18 applies to the presentation and disclosure of information in full financial statement prepared using IFRS accounting standards. So that means those countries who are applying 100% IFRS standard, for them IFRS 18 is must for full financial statement. So whenever a company prepares a proper set of IFRS financial statement, this standard tells them how to structure and display the information, how to show the information to the world. Okay, not how to measure it. See, the measurement standards are still different. For example, IS 16 tells the measurement criteria for property, plant and equipment. IS 40 tells the measurement criteria for investment property. IS 38 tells the measurement criteria for intangible asset, and so on. Okay, so for measurement there are separate standards. What parts of the financial statements are covered? IFRS 18 focus on the layout of, yes, the statement of profit or loss, the income statement, the SOCI, I hope you remember, SOFP, statement of financial position, and statement. These three statements. It will discuss in more detail about these three statements: SOCI, SOCI, and SOFP. I told you. It also sets rules for the notes to the account where detailed explanation and breakdowns are given. Example. Now this is very good. Think of IFRS 18 as a dress code for financial statements. It does not tell you what to bring to the party. That's for the recognition and measurement standard like IFRS 15 or 16, but it does tell you how to dress everything. Okay, it won't tell you that what, see the words, what to bring to the party. That means what to include. The measurement thing is still under the control of IFRS 15, IFRS 16, IFRS 9. They tell us the measurement, but it tells you about the presentation, how to present all these things in a financial statement. Okay, now what about the statement of cash flows? Yes, till now today's date, cash flow is still governed by IAS 7. Cash flow is still governed by IAS 7, but IFRS 18 general presentation rules such as consistency and clarity also apply to the cash flow statement. Yes, these are the general principles still applies, the consistency and all these things. Other IFRS standard still matters. IFRS 18 focuses on presentation and disclosure only. Other standard like IFRS 19, 15. See, I've already taught you this. I've already covered this, that all the measurement recognition criteria are covered by the other standards. Now, what about the interim financial statement? First of all, interim financial statement, financial report is the statement which is less than 12 months. So yes, in this world which we are living, there are companies, they do quarterly reporting, half yearly reporting like this. So first of all, the half yearly report or quarterly report is interim report. For interim reporting, we don't apply IFRS 18, we just apply IS 34, first thing. But however, certain presentation and disclosure principles like consistency in line items and comparatives still apply. Yes. See, if you have ever invested in a stock market, so you know investors compares quarterly reports with yearly reports. Yes, they think like that in one quarter the sales is this much million, so in next 12 months it should be like this million, right? So they compare it with quarterly reports with yearly reports. So that's why the line items means, listen, sales, cost of sales, gross profit, the major line items should be same between interim report and yearly reports. Okay, for comparison purpose. Now the next thing, quick tip, if you are preparing a short quarterly snapshot, IFRS 18 is not fully in play. But if you are doing a full annual movie, IFRS 18 is your director. Yes. If you are making a short reel, IFRS 18 won't apply completely. But yes, on complete movie it will apply. Just to understand. What if you are not for profit organization? Yes, you know that. Very simple. Not for profit organizations, for example, ACCA, that Cambridge, ONA levels Cambridge, right? There are charities, they are not for profit organization. So first of all, as in the basic studies, you have studied that not for profit organization also makes profits, but their primary objective is not to making profit. So that's why when you are making accounts for not for profit organization, you can use, you need to change the language. For example, instead of profit you will use the word surplus, instead of loss you'll use the word deficit. Okay, so use that type of structure that match with your organization. And you know, that's the beauty of IFRS. You know, IFRS standards are flexible as compared to US GAAP. United States GAAPs are very rule based. Our IFRS are principle based. That's why flexible and easy to apply. Read it. So a charity may rename the statement of profit and loss to statement of surplus and deficits. Yes, the structure stays, but the label changes. Now the next thing is, what if you don't have traditional equity like mutual funds? Listen. Hope you guys studied IFRS 9 with me, the financial instrument standard, and I taught you guys about the mutual funds. What the mutual funds guys do, from one end they take money from the public and they issue units. They pick money from the people and they issue units, and now they invest this amount to the stock market or different markets. Okay, so listen, they don't have their own money, they have taken money from the public. Now whatever money they have taken from the public, they are redeemable. The units which we have issued to the public are redeemable. What does it mean? It means if people, the public, the unit holders press one button of redemption, we need to pay back the amount within 3 days. So as a mutual fund, on us, this amount is repayable on demand. This is repayable. There is a contractual obligation to deliver cash. There is a contractual obligation to deliver cash. In such cases it's a liability, not equity, right? I have taught you this thing in your IFRS 9 studies. Okay, so see, some entities like mutual funds and cooperatives may not have equity in the usual sense. For instance, a housing corporation might let members withdraw their investment, which makes a liability, yes, repayable on demand. These entities must adopt the way they present members or unit holders' interest in the financial statement. Yes, so they basically report it in the liability, not equity. Okay, and that's what IFRS 18 also says. Again the same, if member can ask for the money back the entity owes. Okay, now the last thing, management commentary. First of all, let me explain you. See, one thing which is called IFRS financial statement. This is IFRS financial statement is a separate area of the big book. Whatever big book which shareholder receives annually, in that book there are a lot of things, CEO reports, review by chairman, blah blah blah, many things, and also IFRS financial statement. So IFRS financial statement should be given a quite different prominence so that people come to know this is the IFRS area. But with the IFRS area, as you know, in your strategic level course, there are other short areas like management commentary. I have also covered this area in my revision days. So management commentary means the senior level people of management comment on the financial statement, on the company's performance, that what we are thinking about the future of the company, how we see the risk of the company, how we see our progress. So that extra thing is also good for shareholder, but that's not an IFRS material at all. That's extra thing. Okay, so many companies also provide a management commentary or financial review where they explain how the year went, what risk they face, and what future might hold. While useful, this kind of commentary is not covered by, it's not IFRS 18 area. It is considered outside the IFRS financial statement. Now listen to the example. Think of this like a movie behind the scenes. Hope you remember behind the scenes. Interview, it helps to understand the story better, but it is not part of the movie itself. So yes, management commentary is good thing. It gives information, but it's not part of the IFRS thing. And I would say one more thing, that with, as you see nowadays, with a lot of risk in the companies, sometimes we see tariff wars, sometimes we see real wars, lot of wars happening all over the world. You can see gold prices is going up, and same thing, AI is roaring, AI it at peak. So in that case, the companies has got high risk. So if management comment, now a management commentary is quite important to see the future of the company. Okay, right? But management commentary is not part of IFRS 18. It's not part of IFRS 18 at all. Sir. Okay, so now general requirement for financial statement. First of all, very quick, very basic discussion. If even if you say, we have, sir, we have already studied this in our life. First of all, objective of financial statement is to provide useful information about the entity's asset, liabilities, equity to the users, right? Okay, now what is the complete set of financial statements? See, this is, hope you remember, SOCI, the name is statement of financial performance, profit and loss plus OCI, then statement of financial position, which is also called balance sheet, then statement of changes in equity, which is also called SOCI in short, then statement of cash flows, notes to the accounts, then we have comparatives from previous periods. Yes, my dear student, if you report only 1 year data to shareholder won't get happy. Shareholder needs comparison so that they can check the performance. Okay, and the opening balance sheet only when required. It's about retrospective adjustments. Hope you remember IAS 8. Yes, I taught you guys retrospective. Okay, these statements are called primary financial statement and can have alternative titles of balance sheet instead of statement of financial position. Okay, now how can you present profit and presentation of profit and loss and other comprehensive income? Listen very carefully now. You know, international research says that 99% shareholders, when they get the financial statement, they only open the one page, and that page is called income statement, because each and every shareholder is interested in EPS, profit, how is the profitability going. Okay, so when they open income statement page, they also see OCI, because in 2005 or 6, where years back, decades back, IS1 was changed and they included OCI with income statement. They connected OCI with income statement. Okay, so now you have two options. Either on the one page, in the single page, you need to make profit and loss till profit after tax, and then in the same page you connect OCI area. Okay, and the second option is on one page complete you report profit and loss, and on the very next page you report OCI. Okay, so OCI should be connected with profit and loss. That's the objective. Now, equal importance. All primary financial statements must be given equal importance. Yes. Role of primary statement: give a summarize or structure view. And what is the notes? Notes means disclosures, provide detailed explanation and extra information. Yes. Okay. Listen, let me explain you. For example, I have one generator with me. So yes, in the balance sheet, in the SOFP, I'll report my generator. under IAS 16 because I'm using it, but that generator, that showing the generator in the SOFB, showing the generator in the SOFB, showing the generator in the SOFB, listen to me, showing the generator in the SOFB, not enough for shareholders. Why? Shareholders want to know when did you buy it, what is the method of depreciation, straight line or reducing balance, which model you are applying, revaluation model or cost model, what is the life of that asset, many things. Okay, so for all these details we do disclosure. Okay, notes should include material information. Notes should include material information and deeper breakdowns and context. Now what is materiality? Very simple, quick 1 minute game. All information that changes decision of shareholder, information that changes the decision of user is called material information. Okay, for example, if you provide that information, the decision of the user is X. If you don't provide, it's Y. Okay, so entities don't have to follow disclosure rules if the information is not material, but if standard disclosures aren't enough, additional info, yes, voluntary disclosures you can also add, that's still allowed. Structure and line items. Now listen, this is good thing. Many years back that it came in the past paper, I saw it. Structure. Each primary statement has a structure defined in IFRS 18, like income statement, SOFP. I'll also show you. There is a statement proper structure. Required line items may be omitted if not useful or material. Yes, for example, see, this is the line item: sales, cost of sale, GP, admin expense. Line items which are presented on the face of income statement or SOFP or SOCF. Now, can we omit a line item? Yes, we can omit if it is not useful and not material. If that line item is not useful and not material, then you can omit it. Okay, right? Now what about, can we add new line items? Can we add new line items? Yes, you can add. Additional line items can be added if they improve understanding, means if they are relevant, if they increase the relevance of the financial statement, but they must use IFRS compliant. Yes, you need to copy paste IFRS numbers on which IFRS is applied. Okay, then fit the statement's structure, that it should not disbalance the structure. Let me give you one example. You know, there are some professional marks for your strategic paper. You know, you have seen in the past paper professional marks. So many trainers say this, that professional marks can obtain if there is a good flow of sentences. That means sentences properly fits with the paragraph. Okay, so it should fit with the structure. Stay consistent over time. Yes, if you have added that line item this year, then next year you should also add, and so on. It should be consistent. Not overshadow required totals, or it should be not too much. Like if you keep adding line item and the income statement becomes 5 pages, so then it should be too much burden for shareholder to read it. Now, identification of financial statements. Financial statement must be clearly identified and separated from any other info in a published document like annual reports. Yes, I have already covered this. You get a complete book. When you are a shareholder, you get a complete book. In that complete book, there is a CEO report, management review, the director's report. There is like chairman review, lot of things. And yes, there is a financial statement of IFRS compliant. So there are boundaries. The financial statement should be highlighted. The IFRS area, the SOCI, SOCI, SOFP should be highlighted that these areas are governed by IFRS, so that shareholder can trust and make decisions based on those areas. Okay. IFRS rules apply only to the financial statement, not to the things like CEO letters. This is important. Every statement of IFRS should entity name. Hope you remember when we make SOCI, we write XYZ company since we are kids. Whether it is individual or consolidated, yes, if you are making single company's financial statement or consolidated, you must write. Reporting period ending date, reporting period ending date. Okay, currency, which currency you have used, level of rounding, example thousands and millions, these all. Okay, then frequency of reporting, a complete set of financial statement must be prepared at least once a year. That's normal practice. If the reporting period is longer or shorter than a year, the entity must explain why change occurred, why you are changing the accounting period. You need to give the disclosure for this. Mention that figures may not comparable with prior period. Yes, the last time period is 10 months and this time it's 12 months, or last time it's 15 months and this time 12 months. So you must inform your shareholders that be careful while comparing it. Be careful while comparing it. Don't go out of track. Reporting for non-standard period like is allowed if done consistently. Yes, if you are making 6 months or 8 months financial statement, but do it with consistency, then it's okay, then it's comparable. Now, next thing is basically just I'm telling you it's same as IS 8. It's same as IAS 8. Okay. Hope you remember when I taught you guys IS 8, I told you that accounting policy, if you are changing the accounting policy, you can only change the accounting policy because of these two reasons. See the screen. Number one, if the IFRS standard is saying to change it, any standard is saying to change it, then do it. Yes. Or if that accounting policy change can increase the relevance and reliability of financial statement, then you can change it. See the same two lines. The presentation classification must remain same every year unless a major change in the business makes new format more appropriate. See, it increases your presentation, then you can change. An IFRS standard requires it, or see, or. So it's same as IS 8. Entities must provide comparative figures for all financial data from the previous period. Narrative or descriptive comparison must be included if they help to understand current period. Yes, even you need to do disclosure for comparative as well. Okay. Reclassification and adjustments. If items are reclassified, move to another category or renamed. For example, listen. Previously you were on revaluation model, now you shifted to cost model, or previously you were on cost model, now you shifted to revaluation model. In such a case, you know, this is basically change in accounting policy, and we all know changes in accounting policy must be applied retrospectively. Okay, so you need to explain, restate prior period comparatives if practicable. Yes, because there is one exception. If going retrospective is impracticable, then leave it. Now you need to clearly explain what changed, the amounts affected, and why the change was made. Why did you change it? Okay, so all these things you need to disclose. If restating is impracticable, example old data not available, disclose why it is impractical and what would have been adjusted. Okay, if you can't go back and if you can't do it retrospectively because of impracticability, then give the disclosure for that. That is important. I hope you remember all these things are already covered in IS 8. This is all revision. All these things I have already covered. Now, one more thing I would like to explain here. When I was teaching you guys IS 8, I taught this thing that if there is a policy, accounting policy change in this year, then what you do, you revise 3 SOFPs and 2 SOCI. First of all, year-end SOFP. There is a policy year-end SOFP with the new policy, the beginning SOFP of this year, and the beginning SOFP of last year. 3 SOFPs and 2 SOCI you need to restate. Okay, right? For retrospective application changes in accounting policy. See, third statement of financial position. In special cases, a third balance sheet is required at the start. See that it is dark. At the start of earliest period. See this period. They are talking about this period. At the start of earliest period presented when a retrospective accounting policy change. Number one, A correction of an error. Yes, this is also IS 8. Hope you remember in IAS 8 you studied that if one error or fraud occurred in past and discovered now, then you should go back in the past. Then you should go back in the past and you should restate things. You should go back in the past and you should restate things retrospectively. Okay, or a reclassification has material impact on opening balances. Again, this is a policy change. So three balance sheet are shown. See, I have already covered this. End of current period, this one, end of previous period, this one, and then this one. But detailed notes are not required for this third one. No extra details for this third one. Okay. Just giving you 1 or 2 minutes to read it. Read it, please. It's all old things. Now finally we are touching aggregation and disaggregation. Now what is this? Aggregation means you are going to group certain items and disaggregation means you are going to separate it. Okay, so both of these things are allowed according to the usefulness. So first of all, what is an item? Item is an asset, liability, equity, income or expense or cash flow, or even a combination of these. Now what is line item? A line item is when one of these is shown separately. Anything which is shown separately on the face of the statement, that is called line item. For example, sales revenue. Sales revenue is a line item. Cost of sales is a line item. Gross profit is a line item. It is always shown separately. Okay, right? Principles to follow. Now entities should group similar items together. Example, all short-term loans. Now how to do grouping? Similar items like loans, lease liabilities can be grouped like this. Okay, operating expenses can be grouped. Now split different items apart. Don't mix salaries with advertising expenses. Now there is a difference now. Okay, now present these clearly in main statement like balance sheet or income statement or in the notes depending on what's more useful. Again, I would say it's principle based. That's the beauty of IFRS, that IFRS are principle based. Okay, then make sure that grouping does not hide important information, material info in a, like you have very small immaterial information, and with those lot of immaterial information you packed one material information and you hide it. Okay, so what is the example? If you show other expenses of $1 million but inside that 600,000 is legal penalties and that is material and unusual exceptional item, so it should be shown separately or disclosed in the notes, right? So no need to hide such big penalties inside operating expenses or other expenses umbrella. That will be some sort of misguiding for shareholders. Then disaggregation when necessary. Disaggregation when necessary. If something is material, important enough to influence decisions, you must show it separately. It's not shown in the main statement, then at least disclose in the notes. Yes, listen. For example, there is some material item, an unusual item, anything that is very special for shareholder, then you must show it separately. Or if you can't show it separately, then at least make a disclosure for it. Okay, example, suppose you have grouped your sales under revenue, but part of that is one-time gain from selling old machinery. That's not regular income, so you must disaggregate and show it separately to avoid misleading users, right? Are you getting? Because sale of fixed asset are bought not for resale, it's for usage. So it's a one-time thing. It's a one-time thing. So if you have included one-time revenue in normal revenue, so you should disaggregate it or at least disclose it. Yes, labeling matters. Names and descriptions in your statement must reflect what the item actually is. Don't just write other income. There, it's a routine practice to throw many things under the umbrella of other income. So that's also misleading. Also explain any unusual terms and how you grouped items so users aren't left guessing. Now, there is one area which we called offsetting rules. I hope you remember I taught this offsetting in IS 37 and then IFRS 9 as well. For example, I have a receivable of 1 million and payable of 200,000. So can I cancel it and report a net receivable of 800,000? Yes, we can do it, but there are certain conditions of IFRS 9, like same parties, you should have legal and enforceable rights to cancel, right? So there is a topic for it. So now what they are saying, you cannot simply net off, subtract one from the other, your assets, liabilities, or your unless a specific IFRS standard allows it. For example, IFRS 9. Otherwise, it is not allowed. Example, you owe a supplier rupees 1 million and they also owe you rupees 200,000. You can't just show rupees 800,000 as a net payable unless IFRS permits it. Okay. However, valuation allowances are okay. For instance, you can reduce your inventory by an allowance for obsolete. Yes, it's inventory should be recorded at lower of cost or NRV, and that inventory is a one thing. Okay, so in that case you can make inventory allowance and that's not an issue, right? Final thought. Think of it like organizing your wardrobe. You don't mix socks with shirts, disaggregation, definitely. But you also don't hang each sock separately, you just make a pile of socks. Okay, aggregation, where the goal is to keep things clear, organized, and easy for users, investors, regulators, and auditors to understand your financial story. Okay, so that's it for today's class. We'll be doing more in the next meeting. Thank you and take care.